Welcome to this week's live ASX strategy session. Thanks for joining me. Great having you with me for another show. And of course, we are doing this on Thursday this week, and that is because we have the public holiday on Friday for Anzac Day. So, recording this on Thursday afternoon in Sydney. All right. Now, lots of interesting things to go through today. Heaps of things going on in the markets, both stocks and commodities. I want to have a look at all the stock codes that you might be thinking about and looking at, because of course we missed that last week during the Easter break, and of course, first of all, everything today is general commentary only. Doesn't take your personal situation into account. Now, having been through all that, let's get into our first chart. So we're going to start with the ASX 200 and a strong rally for the ASX 200 this week, with prices getting back towards the top of where prices were prior to that sharp sell-off a couple of weeks back. So on the surface, the rally is certainly encouraging, but there's a bit more to it than initially meets the eye. And I think it's also something that most people probably don't realize. I'll go through that, tell you what I mean by that in a moment. And then this also ties in with what's going on in the US. I'll cover that after the ASX. There's an important indicator that I want to update you on. It's reached a point that I think you probably should see. But let's just start. Let's start with this latest price action in the ASX 200. So the rally is now back to the 50-day moving average, and above there we have the 100-day moving average. And so prices were extremely stretched below the 50-day moving average 2 weeks ago. And as we've previously discussed, when prices get stretched, just like when you pull back on a rubber band, they often snap back. And that's what we have here. The question is, what happens now? The underlying structure is still bearish, and that's because prices remain below the moving averages. And whilst that remains the case, I think we need to approach the market with caution. At the moment, the price is just starting to nudge above the 50-day moving average, but nonetheless, the moving averages are still in a downward sloping position. So that's for me, that still calls for some caution. Now, when I say caution, I don't mean being bearish. I think we should keep an open mind that this could well be a panic-driven sell-off, and that the worst is in fact over. But when I say caution, I mean it in the sense of just being conservative with risk. So while prices are below these moving averages, there's just a natural vulnerability to the structure. It's as simple as that. When prices are above rising moving averages, well, that's all great. That's when there's a tendency to buy the dips and prices trend higher. But when prices are below the averages, there's that greater risk that rallies get sold, like they did a few weeks back. Doesn't mean this one's going to get sold, but it means we do need to be very much open to that possibility as well, that the rally back to the average stalls and prices come off. And with the ASX 200 right on this 50-day moving average, I think this is really shaping up as a critical point. I think a positive is that the ASX 200 is doing a really good job at holding on to most of the gains off the lows. You can see the rallies off the lows, and market is holding those gains well. We saw that last week with this narrow consolidation. So prices they rallied, they pulled back. They rallied back, and then we had a whole week of prices just trading in a narrow range. So that's encouraging when that happens. And I think the fact that prices are holding their ground suggests that buyers are accumulating on the pullbacks, and that there's not a rush to sell into the rallies. So I think those shape up as positive things. What is interesting is the source of Tuesday's rallies. You can see this big up day on Tuesday, and much of that was due to one stock, and that one stock is CBA. So just click across here, have a look at CBA. how strong that's been over the last, really over this entire period. It's remained a strong stock. Despite all the volatility, CBA hit a new all-time high on Wednesday. There's not many stocks we can talk about at the moment that are hitting all-time highs. Just as an aside, if you own CBA and if you've been using a wide trailing stop, then you probably still own it. So far, this sell-off we had, it came back about 12, 14% thereabouts. So far, this has been a completely survivable bout of volatility. CBA, it's a motion trader stock. It's still in the motion trader portfolio. And I think that's an advantage of using wide calculated stop losses or trailing stops. And that's because they avoid unnecessary panic selling when we do get these periods of heightened uncertainty in the market. And I think if you want to use a calculated trailing stop loss, well, come across to Motion Trader, see what I'm doing there with that calculated stop process. And I think knowing when to hold and when to sell, it can make a big difference, as it has for anyone using a wide stop on CBA during this period. So as I said, CBA, I think this is a big reason behind the ASX 200's rally. Not the only one, but a big part of it. Coming across, and I'll show you why I say that. I'm going to go to the equal weight. So this is a market cap based version of the ASX 200. Well, that is the ASX 200. When you look at it on an equal weight, and CBA is just one stock out of 200, the rally from Tuesday, it's not quite as impressive. It's still a rally, but you can just see how much influence CBA had when you look at it on an equal weighted basis. And this is still, when we look at it on the equal weight basis, the market, it hasn't been as strong, although it is still encouraging that it's been holding on to the gains off the lows. So that same encouraging piece of price action is still intact. This week's rally, yes, it's not as notable as we've been discussing. The equal weight, it's still below the moving averages. There's the 50-day. So while the ASX 200 is nudging up to its 50-day moving average at the moment, you can see the equal weight isn't. So that's where you've got that influence of stocks like CBA. So we're below the moving averages, and the moving averages are still pointing lower. So they're things to keep in mind. Also, we've got this resistance region, which comes in at around 1,840. We've looked at this before. It goes all the way back to the pre-COVID peak, technically active region, and this is where the equal weight's just nudging up to now. I think the next step in a recovery is to break above this region. It's getting to the top of it at the moment. Just in today's trading, we are getting towards the top of it. It's not where I've got these this shaded region. It's not precise. It's more of a general marker. But if we can see the equal weight get through, then get towards the 50-day moving average, well, then you'd say, look, it's starting to clear that zone. And I think if that happens, then it increases the odds, I think, that all this was a panic-driven event and not a larger bearish turn. So let's see whether we can get a little bit more strength and start to get back towards the moving averages. Coming back to the ASX 200, I've spoken about the possibility of conservatively buying an ASX 200 ETF over the last couple of weeks as prices have started to recover. This would be part of a longer term strategy, not a short term play. If you were considering that idea, as I say, a longer term positioning, I still think that's something that's worth considering. But I'm less enthusiastic about buying individual stocks unless they meet the motion trader buy criteria. So of course that's going to be stocks which are above rising moving averages, not stocks which are rebounding from below their moving averages. I'm happy holding ASX 200 ETF longer term, but I don't want to try and pick the lows in individual stocks. and risk getting stuck if prices then do turn lower. I can hold an ASX 200 ETF long term and not be too worried. Individual stocks are another matter. Many things can go wrong when you're looking at an individual company level. I'm still holding stocks in my own portfolio. Still got quite a few stocks that are above their trailing stops. I'm holding them. I'm happy to do so. I bought a handful of stocks over the bought a couple of stocks today. Nothing extreme. Just gently nudging back into a few opportunities as they start to emerge. But I'm also holding extra cash, and I'm happy doing that also. Overall, I'm playing this market defensively. For me, it's not a time for aggressive maneuvers at this point. Now, if you're getting some value from this, please hit that like button. Please leave a short comment. Just, hey, thanks for the video. Tells YouTube you're watching. YouTube shows other people. Helps me heaps. Please do those things. And if you haven't already, come over to Motion Trader and see the signals surface that I do, because that could also be something which could be quite helpful when we do get markets back into trending phases. Now, we're going to get to the commodities and such in a moment. First of all, let's get into the S&P 500. Well, this is getting interesting with where things are now. Is this a basing period is this the basing period we've been looking for? I think the potential of that is certainly there. I think the next few days could tell us a lot. What I'm thinking is that this is a critical stage within this broader period with where prices are now. I think the best part of this is that we do have some clear levels to base our decisions around. On the upside, I think the level to watch is around 5,500. So let me just draw that in. And it's just through here where I've got this blue shaded area. So what this does, this takes in the March low, it takes in the April high, and prices briefly got there on Wednesday trading in the US before pulling back during the day. And so this is an area to watch. And also just looking in, just having a look at Wednesday's price action, because this is interesting in itself. So we can see it nice and clearly now. Now I've expanded it. So what we had on Wednesday is prices opened strongly. So you can see where they closed on Tuesday, and you can see where they opened on Wednesday. They rallied, and then they started coming back through the day, and they closed near their low. So on the surface, when you look at that, and when I looked at this first thing this morning, I looked at this and thought, that's not great price action. That's actually on the negative side where it can't hold its gains and it closes on its lows. But then I zoomed in on the price action. I jumped to a 15-minute chart just to see how the day played out. So let's do that now. Let's look at this on a 15-minute basis. So this brings this whole area where you can see I'm just circling around. That's on the daily chart, that's a single bar. But when you look at it on a say a 15-minute or an hourly, you get the breakdown of the day's trading. And so what you can see, there's the Tuesday close, gapped higher on the open, initially traded up, and then we've got this pullback through the day. But just look at the pullback. It's not aggressive selling, rather it's a slow grind lower. And what that suggests to me is that there's interest in buying this dip. Gapped higher, pulled back, and the interest is there to buy the dip. So I think Wednesday's price action isn't what it first seems. I think it's actually encouraging, and it gives the appearance that the market is going to try and rally and retest this resistance at 5,500 and potentially break through it. So let's go back to the daily chart. And I think if the S&P 500 were to break through 5,500, I think that would open further upside potential and increase the odds that the sell-off was indeed a panic-driven event and not the start of a larger bearish period. I want to show you an indicator now. Let's go over, we looked at this last week. This is a percentage of S&P 500 stocks above their 100-day moving average. And you can go back to previous weeks where I explain it all, but basically when there's like, this is like percentages down here, when you get 10% of stocks above their 100-day moving average, it's telling you the market is about it's super bearish. Most stocks are washed out. It's where lows form, and the opposite applies when you get an extreme amount of stocks above their moving averages. That's where tops form. So what's happened here is that this has now moved to a secondary high. So from the low, so broke down, got down to 10%, bit below 10%, had an initial move higher, indicator then pulled back, and now we've got a secondary high got to around 30% of stocks above their 100-day moving average on Wednesday. And so what this is, I think this is a sign that the internal strength of the market is improving. The fact that a growing number of stocks are above their 100-day moving average, I think, is positive. And when that happens, there's a tendency for momentum to build and prices to move higher. And I think Wednesday's move in the indicator above the previous peak from April, I think that's important as well. Because what happened? Let me just compress this a bit. When we look back at past examples of this situation, the secondary high, like we have here on Wednesday, the secondary high is typically a confirmation of a shift in momentum. So, for example, we can look at this period there's two examples from 2002. So, look, this first one from 2002 broke below 10%, rallied back, initial high, pulled back, secondary high. That was confirmation of a turn. It wasn't the final low, but it was a multi-week, possibly even a two or so month rally. There was a significant rally. Then there was another low in September 2002, initial rally, pull back, secondary high, and then the market was away again. And I'll show you, just duck back one more, because you can see this is a reoccurring theme of how this often plays out. From 2015 and 2016, you can see market rallies, the indicator moves up, which is with the market rallying. Then it pulls back. You can see the two pullbacks. Then you get the secondary peaks, and it coincides with rallies in the market. So you can get up the S&P 500 chart yourself, go through, have a closer look at that. So coming back to current day. Now, there's absolutely no guarantee that it will work that way again, but I think the presence of this setup, I think it shifts the odds in that direction. Let's bring it back to the S&P 500. So if this 5,500 level breaks, should we go all in and start getting super bullish? And my answer to that is I don't think so. I think we should be conservative in any action that we take at the moment. And I'm maintaining a defensive footing while prices are below these declining moving averages. Yes, I think this is setting up in a way that could lead to maybe a multi-week rally. But we don't know. It doesn't necessarily mean that this is completely blown over and it's off to new highs. All sorts of things can still happen. So to give you a bearish scenario, maybe we get a break up, maybe we get a multi-week rally that takes prices back up towards this resistance to around 5,800. Then it could be a case that in say late May or June, prices start to turn lower again. So all sorts of ways this can play out. There's still a high degree of uncertainty. So that's why I say I'm maintaining a defensive footing, but starting to put a foot forward as the price action and as some of these things are lining up in favour of potential strength coming back into the market. I also saw something that worries me through the week. And again, this is why I'm still maintaining a cautious and defensive approach. Yes, there are a few things lining up, like that the oversold indicators and percentage of stocks below their 100-day moving average. Those sort of things are lining up. But I'll show you something which did bother me a bit. So this turned up in my X feed through the week, and it comes from Bloomberg, and what this is showing is, so this is it's showing the amount of money going into leveraged long ETFs. So 6.6 billion, and Bloomberg says that's a record inflow coming into leveraged ETFs. So not just regular ETFs, but ETFs where there's leverage. That might be 2 times or 3 times or whatever it may be. And you can just look at this from pretty much from March. You can see how this has really been some aggressive buying compared to what we've seen since 2003. And that's this what we've seen the last few weeks. That's typically not what we see at lows. Big buying is actually more associated with tops. So it's a bit confusing when you look at the market in its current context, some of the indicators we're seeing, but then you see this ultra confidence and buying leveraged ETFs. Just look at, like for instance, look at this period. So this is 2004. Let's go to July 2004 and then move along a bit. So the midpoint is around, late July. You can see these 3 big bars here. So these 3 bars here in mid-July 2004, I'll just quickly go back to this, to the S&P 500 period. It was after this strong rise in the market, and then we had a correction. So again, associated with market tops, a big influx of confident buying. And then you go back to, let's say we look at around November 2003, that's where the market put in an important low. There's no inflows into leveraged ETFs then. In fact, it was in reverse. Money was going out. And so this high conviction we're seeing at the moment does concern me, and I think it's just another reason for being defensive. I don't think it's a reason for being negative. I don't think it's a reason to scare us out of the market, but it means we should be aware of risk and carefully managing risk when we're in an environment like we currently are. I think we could make an argument. I think we could make an argument one way or the other. Like you could get this graphic here, and just take to go on a one-sided bearish view, or you could look at some of those old oversold indicators and go on a one-sided bullish view. And many people will do that. They'll go to one extreme or the other. But what I think we should be doing, it's considering the evidence on both sides and then being guided by the price action. So at the moment, the price action is pushing towards a more optimistic position. So I'm prepared to go with that. And I actually bought some S&P 500 EFX ETF, I should say, some S&P 500 ETF I bought it on the ASX just before doing this. I'm just nibbling. It's a nibbling position. It's not a big swing. I don't think this is a time for that, but I'm being guided by the price action. That's what it's currently telling me. I'm prepared to move towards the bullish side at the moment, and I think longer term averaging into ETFs, I think that could be considered, but don't gloss over the risks. And when you see a graphic like this, don't gloss over them. This remains a market below declining moving averages, and I think that warrants caution. It's as simple as that. We want markets above rising moving averages. That's the bull zone. We're in the bear zone at the moment. Okay, so we're going to go to the small caps next. We're going to do the commodities. We're going to do individual stocks, any codes you want, load them up. Let's have a look at them. But of course, that wraps up the free section. If you're not a strategy session member, there's a link below. Click that, come in. Costs so little money for all the sort of things that we go through and the access to information that you get. So think about doing that if you really want to get stuck into some of this technical information around markets. And okay, so let's go to the Russell. The Russell